What is up, guys? My name is Matthew. Welcome back to the channel. Today we have a hidden gem stock that I think is going to be pretty great in the next couple of years. This one is going under the radar. Not many people are picking it up. So let's get straight into the video. Let me just show you guys why I'm so excited about this stock. That stock is nonetheless Crocs. You know those ugly ass shoes that people are wearing? They got the ones that got the holes in them? Yes. Yes, this company, I think, has the potential to make us some money. Now, in today's video, I'm going to go over what the company is, a little company overview, some financial performance of this company, competitive advantages and business models of this company, risks and challenges that they might be facing. And I think my face is blogging, so I'm going to go into the stock valuation and price target as well, and my take and what am I doing with the stock. So without further ado, let's get into it. What does Crocs actually do? They make these styrofoam looking shoes that are actually made from Croslite, and they're expanding into the clogs category that are sandals and as well as hey dudes that you can see here in the second picture. They're a footwear brand known for comfort and casual style. So these are kind of shoes that you grab to go to the backyard or mow the lawn with, or if you're having a cozy day, you kind of just slap them on, you know. They're kind of known for that. So the market presence, where is Crocs doing business? And today they have a couple of regions that they're doing business in. That's worldwide. A lot of their business is actually pretty strong globally, but they have a really strong presence within North America, the USA. So just a geography basis, North America is about 56% of their market that they're hitting, and 44% comes from international. So going into the revenue growth here, we could see that this line right here is just a straight upward trend. So ever since 2018, they've been able to bring in $1.1 billion of revenue, and today $4.1 billion of revenue that they just reported. So if you annualize this on a compound annual growth rate, that is a 25% return on just their revenue growth alone. Going to the EPS, the earnings per share, we can see that this is also just up and straight to the right. That's what we love to see. So for 2018, EPS was 86 cents, and today is $13.17 in EPS. You can just see that massive growth that we've been able to accomplish here in just a span of 6 years. That's a 58% compound annual growth rate, and we love to see that. Gross margin trend. I kind of noted some ups and downs here. So in actually the 2021 year, that was our best year for gross margins. That was about 61%. And over the past couple of years, they've been trying to kind of chase back to those COVID best times because everyone was at home using Crocs, and there's nothing really you could do besides just go in your backyard and do some yard work, right? So margins fell at 52%. They started increasing in 2023 to 55%, and today we're at 58% in gross profit margin. Now, we can see that today they're at a 58% gross margin, and that is a lot of money. So you kind of look at it in terms of what have they been able to sell, and what do those sales cost them, and that they're able to take home about $58 just by profiting and operating alone. And you can see that this is pretty high if you were to compare this to other industries, and just having a hardware product like this, or like a physical product that you actually have to manufacture. This is pretty high. So going into the free cash flow trend, this alone is up and to the right. They just reported $920 million of free cash flow. Take into mind that they are only a $6 billion market cap, and they're almost bringing in $1 billion of free cash flow, 9.2. So that puts us at a free cash flow yield of 15.3%. Tell me where you can find a free cash flow yield of 15%. That's pretty amazing. But if I actually go to ProfitViz right here and look at their per share annual free cash flow growth, we're looking at 17% year over year free cash flow growth. That's really good. I like that. But if you were to take out this per share option, we are going to look at 13% year over year. The reason why it's 13% and 17% when we go on a per share basis is because they're buying back so many shares. Every single quarter, every single year, they are buying back shares. And that's what you love to see in a company like this, because they're able to return that money back to the shareholders. And essentially, they're buying back the stock at cheaper prices, taking shares off the market so you can actually own a bigger stake in the company. But let's go back to here. What are the opportunities of this company here? I see that they are in a $4.1 billion. That's what they believe that they've captured, $4.1 billion. That's sandals, clogs, and casual, all of them combined together. But they believe that they compete in a 160 billion market cap, or not market cap, 160 billion addressable market. This is the market that they're able to capture. So if they're just at the tip of the iceberg here, what more can they accomplish if they go into other regions and have success there? We know in the US and Korea, they're actually kind of established as well. But this is the growth that this industry and that Crocs has painted out for us. So as I mentioned here, here's some opportunities in market share. We can see that US, UK, and Korea, these are more established markets, but more of the growing markets would be these other industries here. So I'm going to focus on China here because in their most recent earnings report, they came out and said that there's something really notable here that we should look at. So China grew 64% year over year, now representing the second largest Crocs brand market, after the US international tier 1 markets grew 20%, with international now making up 44% of the mix. Now that, my friends, we like to see growth in any region grow by so much. And it's kind of interesting to me that China growth has come so high year over year, because we know that China is really good at what? Making dupes, making fakes. And it's kind of interesting to see that people in China actually want Crocs branded shoes when they could probably make it much cheaper, almost probably for the same amount of time and effort that it takes to make. So looking at the product breakdown, what does Crocs sell? They sell clogs, which are these shoes with the holes in them that you kind of see everyone wearing around. And this is 75% of their business. Now, sandals is actually 13% of their business. And if you look at these little holes, you could put these gibbets on there. And just by them upselling these gibbets, they're able to partner with other companies like McDonald's and more companies alone, just to have different brands to put on their shoes and different designs to put on their shoes. So that's 8% of their business as well. These kind of go hand in hand together, which is kind of what you like to see. Some of the opportunities I think that they can go into are this Hey Dude turnaround. They recently acquired Hey Dude for $2.5 billion. And with the brand, I think they're taking the right initiatives. They actually mentioned that they are assembling a strong roster of high-profile influencers, and those people that are influencers include Sydney Sweeney, the award-winning music artist Jerry Roll, and the Heisman Trophy winner Travis Hunter. Now, these people have huge followings, and altogether, you can see here that over their social channels that they brought in a community of a total following of 2.4 million 2.4 million consumers across all of these platforms. Now, during these holiday seasons, we kind of saw an exceptional Hey Dude brand engagement on TikTok. I was listening to a conference call and they said that TikTok Shop was actually really good for them. And we know that TikTok is back on the App Store. So I only expect Hey Dude and Crocs to utilize the TikTok Shop platform in the next whatever days, as long as we have TikTok still. But I want to go into this Sydney Sweeney portion here. They say that they introduced a direct-to-consumer exclusive bolstered by the strong social and digital marketing campaign featuring Sydney Sweeney. Now, with just Sydney Sweeney's marketing campaign alone, they were able to sell out completely within 2 days. That is the power of having a high-profile influencer. Now, imagine how many people follow Sydney Sweeney, follow Travis Hunter, and want to just wear it because they are. That's so powerful and so strong that we see throughout these brands. And on the conference call, they actually mentioned that they want to strike deals with people that actually have a love for the brand, people that actually want to wear the brand, and really they seek it for their own comfort, not just because they're getting a bag for it. I'm sure that's part of the reason too, but because they actually enjoy the brand overall. Those are the people that Crocs wants to partner up with and create marketing campaigns with as well. Now, where does their capital allocation priorities lie? In their recent earnings call, they want to invest back into their brands. They're committed in redeploying the best in-class gross margins to these investments. They want to pay down their debt. And we know that with the acquisition of Hey Dude being $2.5 billion, they want to pay down that debt. That's what they're doing every single quarter. And they also, I think this is the most important, they want to repurchase their shares. This is an opportunity to buy back the shares at a cheaper discount. And in the most recent conference call, they said that they bought back $1.3 billion of shares. They got an authorization to do that because they believe that the stock is undervalued. So if the team over there thinks it's undervalued, they're buying back the shares, they're returning shareholder value back to us. That's all green flags. And that's what we like to see. So some of the risks and challenges that Crocs might face is that the US, we know that there's tariffs. We know that China is going to be affected. And with China coming into play, things are just going to get more expensive. I'm not too worried about the tariffs being in China or whatever, because that just comes with the cost of doing business. Though the margins might suffer, we do see that they are growing their share within China as well. So I'm thinking that if they grow share in China, we don't have to worry too much about, just costs of things going up. Not so much. And consumer trends, a lot of people might think, are they a fad? Are they going to die out of style? People have been saying this, I think, for the past 5 to 10 years. I think personally that people buy Crocs because it's simple, it's easy, and it's customizable. You think about it, how many kids need shoes every single year, ages 0 to 15? I would assume every single year they're probably growing out of their shoes. They probably need new shoes, whether that be a house slipper or an outdoor slipper. So you have this young audience that needs to upgrade shoes. You have parents that want to make their kids easier for putting on shoes. They want to make their lives easier. I don't know if it's going to ever go out of style. I could see, I don't know, maybe if there was another cheaper option that had the exact same thing, but then you get into patent issues. I think Crocs is doing well. People seem to like the brand. People seem to like the gibbets that they are able to put on there, and I like that. So another risk they might have to do is manage this Hey Dude acquisition. We know that this Hey Dude acquisition didn't go the best as planned. They are still struggling to turn around this business, but it seems that they're taking the right steps. They're taking that brand marketing approach to reach out to influencers and get that sale product launch through there and funnel sales through the Hey Dude platform. So if they could turn around the Hey Dude business, I think this whole business just turns around, because the sentiment is kind of within the Hey Dude acquisition of they're not doing as well as we thought, and they overpaid for just an ugly shoe company being Hey Dude. Could the risk be that there's a lot of dupes? Yes, I'm going to click on this link here. I searched up Crocs dupe. As you can see here, they're kind of ugly, like what you think is a Croc might be ugly. The dupes are 10 times uglier. Like, I don't know. If you were going to wear an ugly shoe and you wanted to wear it, would you wear the uglier version of the shoe? I think maybe if you can get it substantially cheaper. And it's for like the dads that don't really care. But if you're for like a younger crowd, being like a teenage boy or girl, then you might want to get something that, everyone else is wearing around too. I don't know. I feel like the dupes, yes, they're there, but they're just they just can't compete against, something that's just so standardized and has been around. Okay, valuation time. I'm going to do a kind of comparable analysis between Crocs, Deckers, and Nike. And if you don't know Deckers, one of their biggest shoes are Uggs. A lot of people think that Uggs are super ugly and Crocs is super comparable to Uggs because they're both kind of quote unquote fads, and Nike just being a dominant shoe company overall. So let's do a comparative analysis between all of these companies here. We can see that the market cap for Crocs is $6 billion here, with Deckers being 23 billion and Nike being 113 billion. Just that alone, we can see the different sizes in companies here. The PE ratio that you're paying for Crocs is about 7 PE, being the lowest of all the three. And Deckers, which is their other competition that you might see, is trading at 24 times price to earnings. That is almost what? Triple the company. But then if you come back to free cash flow, they only brought in $1 billion of free cash flow. I think if you compare this to Crocs' $920 million, you can see how much more free cash flow that they're able to bring. And that free cash flow allows them to buy back shares, invest in the business, turn around this Hey Dude company. And that's what we love to see overall. If you look at EV, enterprise value to EBITDA ratio here, it's about a 7 versus a 16. You know, if you buy Crocs, you're probably looking at, you own the stock for 7 years. It's paid off. Anything above that, any more time you hold it above that, is just the money's going straight into your pocket. We can see that on a price ratios basis, all of these L's, Crocs is severely undervalued on a price to free cash flow per share basis, on a price to book basis, on a price to sales ratio basis. You're looking at this is fierce competition here. And we're hoping that we can maintain our market and if not increase our market share. All right. And looking into the return on assets, return on capital, they're not able to get as high as Deckers, but they're able to get higher than Nike. But if you look at just looking at the numbers alone, this might be like, I don't think it's recency bias, but I don't think it's just confirmation bias or whatever. But I think that this return on capital of being 29 is still really, really strong for a company. Return on assets being 20%, that's, I believe, solid. Okay, let's go into what analysts might be seeing for this company. So analysts' recommendations or their price targets, we have a average price target of 130. Ooh, my face is covering. We have an average price target of 130 and 153 being on the high side, 110 being the current. Right now, we're trading at 110. And that's just where analysts believe the company's going to go. They don't believe the company's going to increase earnings. They think it's actually be a down year for the stock. And there's 4 buys. Oh, actually, no, there's 4 strong buys, 6 buys, 6 holds. No sells, no nothing. Okay, but here are my moves and here are my predictions. I have opened a position in the company. I was able to purchase 180 shares at an average cost basis of $94 per share. My total cost basis is about $16,900, and we're up 17%. I bought these before the earnings call, and after the earnings call, I only got more confidence. So with this being 30% of this account, it's kind of high, but overall, I think I do want to increase this position because I think they can. I think it's one of the most undervalued companies that I'm seeing out there, given that there's so many high valuations with the stock market right now. They currently trade at a price of $110 per share, and their EPS is 15.8. Now, if we take the current PE, which is 7, and they just stay and do nothing, we're gonna keep a return of 0%, right? But on average, this company, on historical average, this company trades between 11 to 12 PE ratio. So if we go back to those PE ratios, like nothing has changed with the stock. The fundamentals are the same. The only thing is that the Hey Dude business is there. Investors don't like what the companies do with the Hey Dude business, but if they are able to turn around the Hey Dude business, we're going to see these price to earnings ratios again. So just on a price to earnings ratio basis, if we are able, let me put myself back on the screen. If we are able to get our price to earnings ratio basis of back to where the historical average is, we might see $158 on a 10 PE, $174 on an 11 PE, $190 on a 12 PE. And let's say we blow it out of the park. They turn this Hey Dude business around. They get more influencers. They sell more. They get this ugly, quote unquote, ugly shoe to come back into reality and make sales. We could be looking at 100% return on our investment here. But I'm going to remain conservative that anywhere between 57 to 72% is what I will be looking at for the next couple months. And when these companies come back from bad sentiment, you really see them start flying back. Well, that's everything that I have for you today. I hope you guys enjoyed this video. If you guys like these deep dive analysis, make sure that you drop a comment down below. Make sure that you subscribe to the channel, turn on the notifications that you are notified whenever I post a video, and let me know what stock should I analyze next. Thank you guys so much for your time. Hope you have a good one, and peace out. And make sure that with any investment that you do your own due diligence. I am not a licensed professional advisor, and make sure that you're doing your own research, making your own due diligence, and consulting with professionals before you make any type of investment. Thanks. Peace.